Hey everyone. So, what if I told you that some of the smart financial advice you've been following for years is, well, kind of wrong now? Today, we're going to dive into 6 financial truths for 2025 that might just flip the script on everything you thought you knew about money. Let's get into it. So, here's the big question I want you to think about. In this fast changing world, is that financial common sense you've been relying on actually costing you money? It's a serious question, and it's time we found out. All right, here's what's on the docket today. We're going to bust the December car myth. Then I'll show you a super simple 2-account tax hack. After that, we'll talk about the real value of your credit card rewards, a wild new way to beat index funds, and who the real winners of the AI boom might be. And we'll wrap up with a look at this huge disconnect between investing and actually being prepared. First up, let's talk about cars. You know that classic dilemma, right? You see these amazing year-end deals, but there's that nagging voice in your head saying, don't do it, it'll kill the resale value. Well, let's see what the data really says. So, the myth, the fear, is that you buy a car in December and you immediately take this massive hit on its value. But the reality in 2025? Honestly, that whole model year stigma is way overrated. The actual gap in resale value is probably a lot smaller than you think, especially if you're someone who keeps your car for a while. Let's put some real numbers on this. We're talking a resale value gap of just 2 to 10%. And get this, for popular SUVs, it can be as low as 2 to 4%. So the bottom line is, if you're going to own that car for 5, 6, 7 years, that tiny difference becomes almost meaningless over time. Now, compare that small future loss to the massive immediate savings. We're talking about upfront discounts that can be huge. Look at this, up to 4 lakh rupees on some models. That cash in your pocket right now is almost always going to be worth more than a tiny dip in resale value way down the road. Okay, let's move on. Next up is taxes. Everyone's favorite topic, I know. But listen, nobody wants to pay more in capital gains than they absolutely have to. Our second truth is a totally legal and surprisingly simple strategy to lower that bill. And it all hinges on one little rule. That rule is called first in, first out, or FIFO. Put simply, the tax authorities assume the very first shares you buy in a brokerage account are the very first ones you sell. It doesn't matter what you intended to do, this rule is set in stone, and it's exactly what we can use to our advantage. So how does this actually work? Check this out. Let's say in one account you buy some shares at 50 rupees, and later you buy more at 75. When you go to sell, FIFO forces you to use that first, lower price as your cost, which creates a huge taxable gain. But here's the trick. What if you bought that second batch of shares in a completely separate account? Now you can choose to sell from that account. Your cost basis is higher, your taxable gain is way smaller, and boom, your tax bill gets slashed by almost half. Same stock, same sale, but a totally different tax outcome. And just to be super clear, this is not some shady loophole we're talking about. It's a completely legitimate way to structure your investments, basically separating your long-term holds from your shorter-term trades. The bottom line? A little bit of planning can save you a ton of money in taxes. It's all about playing the game smarter. All right, let's switch gears and talk about credit cards. Most of us, we get drawn in by the cards promising the most points for every rupee we spend. But what if I told you that chasing the highest number of points is actually the wrong game? Our third surprising truth is this really simple but powerful idea. More points does not equal more value. The real magic, the real secret, isn't in how many points you collect. It's about what each and every one of those points is actually worth when you go to cash them in. And this is where it gets really, really interesting. So let's say you spend 10 lakh rupees. On one popular card, if you redeem your points for basic stuff, you might get back about 6 or 7,000 rupees. Okay, not bad. But if you redeem those same points smartly for flights, you could double that value. Now look at our high-value card. By transferring those points to a hotel partner, that same spend could turn into 80,000 rupees of real tangible value. That's not just a little better, that is a 10x difference. It just proves it. How you redeem is everything. For years, the gospel of investing has been pretty simple. You can't beat the market, so just buy a low-cost index fund and call it a day. But our fourth truth today reveals a really fascinating new chapter in that old active versus passive investing debate. I love this quote from Rajiv Thakkar because it just flips the whole argument on its head. He says, yeah, people complain about active managers underperforming, but what they forget is that almost all passive funds also underperform their benchmark, even if it's just by a tiny bit because of fees and tracking errors. So if the unbeatable funds are actually guaranteed to lose, well, is there a better way to play? And that's where this new kind of strategy comes in. Instead of trying to be a genius and pick completely different stocks, this new type of fund basically just hugs the index, but with a clever twist. It tries to exploit these small, predictable inefficiencies, like profiting from the shifts when a stock gets added to or dropped from the index. It's not about trying to outsmart the market, it's about being a smarter follower. Okay, let's talk about the biggest buzzword on the planet, AI. You can't escape it. And investors are just pouring billions into the chip makers and the big software companies. But what if the obvious winners aren't going to be the real winners at all? You know, history gives us a perfect lesson here. Just think back to the internet boom in 1999. Everybody was investing in the companies that were building the infrastructure, the picks and shovels of the internet. But who actually ended up being the massive long-term winners? It was the companies that used that infrastructure in ways nobody saw coming, like food delivery and fintech. And that brings us to this really important warning from Ashish Samaya, the CEO of White Oak Capital. He totally gets that AI is going to be revolutionary, but he's also saying, hey, we just don't know who the long-term winners will be. History shows us it's rarely be obvious players. The big takeaway here? Maybe be a little careful about betting the farm on today's AI darlings. And that brings us to our final and, maybe the most important truth of them all. A recent study of the Indian workforce found this really concerning paradox about how we're handling our money, and it reveals a massive disconnect between our ambitions for the future and our preparation for today. Just look at this data. When people were asked if they were ready for a financial shock, like losing a job, only 26%, that's barely 1 in 4 people, felt fully prepared with things like an emergency fund and proper insurance. That means a staggering 74% of people are either totally unprepared or are just kind of hoping their company's insurance will cover them without really understanding it. And this chart right here just slams that point home. This is the paradox. While only 26% of people have a real financial safety net, more than double that, 56%, are actively investing in higher risk things like stocks and mutual funds. It's like we're trying to build the roof of our financial house before we've even poured the foundation. So, what's the playbook for 2025? Well, it's about questioning those old myths, right? Like with car buying, it's about being smarter with your taxes and focusing on the real value you get from your credit cards. It means understanding that the investment world is always changing and being really cautious about hype. But maybe most importantly, it means building that solid safety net before you go chasing those big, risky returns. And that really just leaves us with one final question for you to think about. We're all so focused on investing for a better future, and that's amazing. It's crucial. But take a minute and just ask yourself honestly, are you truly fully prepared for the unexpected things that could happen today?